Hello, I'm Tony Kaye. Welcome to the Economic View. I'm joined by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Good. Let's talk about the GDP numbers and the other numbers that have come out this week and what they actually mean for investors.
Yeah, so GDP out today. Depending on whether or not you want to be really pessimistic or optimistic, you can look into those figures and see both. And the reason for that, so let's look at it. Quarter on quarter grew by 0.8 of 1% compared to the previous quarter in Q1 of 0.3. That's a really big move.
About on target?
Yes, depending on who you listen to. So Bloomberg expectations, that's even. Reuters, it's 0.1% below. Year on year came in at 1.8%. Consensus was 1.9 at Reuters, 1.8 at Bloomberg. So close enough.
Roughly, yeah.
Again, the way you look at it is this. Growth is happening. That's the positive. So the optimist in you can look at, yes, we're actually seeing GDP improving. You can see that, Cyclone Debbie has filtered out. We saw a drop in this quarter, probably because you saw a drop in that quarter of inventory around price. And we know the commodity prices during the April to June quarter fell away. What I would point out, the pessimists will point out the fact that, and I made the joke myself as well, is that you could probably replace the G in GDP with government rather than gross, because without government spending in the last quarter, we would have actually gone backwards. Added 0.6 out of the 0.8 to the GDP on quarter. So without government spending in the last quarter, it would have actually been a little bit not as rosy. Bit sad.
Yeah.
But what you can see, if you look at the I, so the private investment side, still contracting, but it's actually reducing that contraction. So previous quarter it took a lot of points out. It wasn't as bad this time around. And what we did know is that the trade balance, which was always going to be fairly negative on the back of those commodity prices, was down 6%. But in saying that, it was offset by what was going on in net exports. So, like I said, you could have both sides. If you want to be optimistic or pessimistic, you could certainly pick it out. I'd probably choose the optimistic side. And the reason I say that is that there are growing signs inside of it that things are moving in the right direction. Consumption was okay and it's improving. Private investment still contracting, but not as badly. You can see government spending being there. Net exports is quite good. The other part that I'd probably highlight that maybe if you really want to get into the bowels of it, that's quite interesting, household savings is still declining quite rapidly. And the catch to that is the C side, so consumption. Will that be impacted in the future? Now, what you therefore need to bring into this, because this is retrospective data, is that there are signs, and we saw this yesterday with the RBA, around wages are starting to show signs of movement, economic growth is showing signs of movement. CapEx last week showed us that, future intentions of spending are improving.
Yeah.
So that's why I'm probably leaning to the optimistic side rather than the pessimistic side. But as I said, you can cut it both ways.
Yeah, it's still a little bit touch and go in some areas, isn't it?
Yeah, it is. And again, getting into the bowels, you can really look at, non-financial service side was contracting by 5%. But if you look at machinery, which we already saw last week anyway in the CapEx, but plant, machinery, equipment, etc., growing quite rapidly. So again, you can always find and cut and choose this data whichever way you want. Headline figures are probably actually in GDP are one of the only ones I really do pay attention to, and they were good. And as I said, yes, you can look towards Q2 and the fact that, yes, the quarter was supported by government spending, but there are signs that Q3 will be backed up by private spending as well. So pros and cons.
Yeah, one thing leads into the other really invariably, doesn't it?
Yeah. So what I'd also look at the reaction from the Aussie dollar. Initially popped down, but then gained on the back of it. And it's through 80 cents. So it does suggest that there is that sign there. I also took a look at the interbank market, which is the probability, this is the market that takes a look at the probability of a rate movement from the RBA. At the moment, the only chance of seeing a rate movement according to that market is in February next year. It's about 20%. It did tick up, not much, but it did tick up to 22%. So still very unlikely, but the market therefore is suggesting in the initial reactions that it's more on the positive side than the negative side, suggesting inflation possibly may materialize. So that's another way to look at it, is read the markets and what the markets are telling you, and that's probably how I get to where I'm at.
Yeah. So from an investor point of view, it's really just a matter of monitoring all of this stuff in the economy,
Yep.
seeing where the growth is, and what the
we
trends
love
are.
talking about macro thematics when we do these programs. So yeah, I look, again, from my perspective, I always start there, is that have that view, have that idea, okay, here's what's going on in the overall economy, here's what the RBA is saying, here's what the ABS data is releasing, is it supporting my actual thesis or my strategy for investment, yes or no? And that gives you that really good base. Is commodity prices what I'm basing it on? Is the China story what I'm basing it on? Am I pessimistic, optimistic? It just gives you that really good overall umbrella to then sort of bring your strategy down to that bottom-up view. And that's how I think you need to look at it.
Absolutely.
It's the best way to look at it, because then once you get that thematic, okay, let's say it is, I believe that the net export story filters into my commodity story, which is exactly what I personally think at the moment, not personal advice, but that's what I think. Therefore, I can then start doing my research from bottom up. Okay, I want exposure to that thematic. Which firm is it? BHP, Rio, FMG, small cap, blah, blah, blah. That's up to how you do your research, but it gives you that core group to then do your research from the bottom side. So that's why I love talking about it, and it's how I form the sort of the material that I form.
Yeah, it's good advice, and really it's so simple in a way, just looking at what the larger trends are, what's driving them. Then you can, as you say, filter that right down to
exactly, and it helps you at the same time, because you can do all your research of bottom up, completely ignoring the macro thematic, and I know people that do that, and that's their bread and butter, and that's fine. But you could therefore find yourself spending a lot of time doing all the bottom-up research and finding that you hit a headwind, which is external factors that the firm can't control. Again, case in point is something like FMG. They are controlling all the factors that they can control, all the operational side, the capex, the debt, blah, blah, blah. But in the end, they are exposed to an external price, and they're a price taker of iron ore, because they're basically a pure play in it. So that's a really microcosm idea of what we're talking about. So if you could go the other way, you could either bring it in or filter it out of your sort of your search as you're going around sort of looking for your firms. Does the thematic back it up? Go the thematic first, then you can start doing your bottom-up research and going from there.
Evan, always a pleasure to have you.
Thanks, Tony.
Thanks for joining us on The Economic View. We'll see you again next time.
The essence of robo-advice is using technology and digital services to help members or clients reach their financial goals, and helping you improve your portfolio through diversification. That's investment advice. That's automated investment advice. By using technology and automated services is being able to deliver those services cheaply and affordably. Robo-advice or automated investment services are just the start.